Is Bitcoin a digital miracle or a trillion-dollar hallucination? As we push deeper into 2025, the debate has transcended mere price speculation. We're facing an existential question about the very survival of the global financial system as we know it. Some hail it as the future of money, the ultimate liberation from centralized control. Others denounce it as the biggest Ponzi scheme in human history, a ticking time bomb ready to drag millions of unsuspecting investors into financial oblivion. Today, we're tearing down the propaganda. No hype, no tribalism, just cold, hard data and ruthless analysis of the crypto economy and the terrifying signs of a potential bubble that could redefine what we understand about wealth and financial collapse. What's changed? First, we need to understand, what exactly is the crypto economy in 2025? Forget the romantic image of nerds in basements, mining coins. That's over. What we have now is a colossal, multifaceted ecosystem of decentralized finance DeFi moving billions daily smart contracts, automating agreements without intermediaries, institutional investment on a scale unimaginable 5 years ago. The biggest shift, mass adoption by traditional institutions. In the past, Bitcoin was driven by retail, FOMO small investors chasing get-rich-quick dreams. Today, it's commanded by Bitcoin ETFs, sovereign wealth funds, and Wall Street. When BlackRock, Fidelity, and the world's largest asset managers start treating Bitcoin as digital gold, the game changes completely. We're no longer just trading speculative tokens, we're building a parallel financial system, one that doesn't need the Federal Reserve, the European Central Bank, or any centralized authority to function. The numbers nobody can ignore. Let's look at the facts. The total crypto market cap has surpassed $3 trillion. More than 500 million people worldwide own some crypto asset. Daily trading volume rivals the largest traditional stock exchanges. Companies like Tesla, MicroStrategy, and Square hold Bitcoin on their corporate balance sheet. And here's the most disturbing data point. 13% of all circulating Bitcoin is now held by ETFs and regulated institutions. This isn't an underground movement anymore, it's mainstream. And that makes everything far more dangerous or far more legitimate, depending on your perspective. The elephant in the room. But let's talk about the elephant in the room. The topic that Bitcoin evangelists avoid at all costs. The bubble. Skeptics present devastating arguments that simply can't be brushed aside. Argument 1. Zero intrinsic value. Bitcoin doesn't produce cash flow. It doesn't pay dividends. It generates no operating revenue. There are no tangible assets backing it, no factories, no property, no inventory. Compare it to Apple stock. You own a fraction of a company that sells real products, generates real profits, and returns value to shareholders. Bitcoin, it's just code and collective consensus. Argument 2. The catastrophic environmental cost. The Bitcoin network consumes more electricity annually than entire countries, more than Argentina, Norway, or the Netherlands. The carbon footprint is astronomical in an era of climate crisis. We're literally burning energy equivalent to entire nations to maintain a system that processes fewer transactions per second than Visa was handling in the 1990s. The 3 classic bubble signs. There are 3 historical indicators that precede every major financial collapse, and all of them are flashing red right now. Sign 1. Rampant speculative mania. When your Uber driver, your barber, and your grandmother are giving you alpha on obscure meme coins that'll 100x, history has a clear message. The top is near. This is the classic pattern. Dutch tulips in 1637, railway stocks in the 1840s, the dot-com bubble in 2000. Every time everyone knows something can only go up, the crash is already in motion. Sign 2. The greater fool theory. Be brutally honest. Is the price going up because the technology is improving, or just because people expect a greater fool to buy at an even higher price later? When fundamental value completely disconnects from market price and the only justification is number go up, you're not investing. You're playing a financial version of hot potato. Sign 3. Psychotic volatility. A currency that drops 10% in an hour isn't a stable store of value, it's a casino. An asset that can evaporate 30% of your net worth while you sleep isn't money in any functional sense. Imagine receiving your salary in Bitcoin and, when you go to pay rent 3 days later, discovering you've lost 15% of your purchasing power. That's the opposite of functional money. Why hasn't it exploded yet? So if all these signs are present, why hasn't the bubble burst? The answer is complex and unsettling because this time might actually be different. Reason 1. Programmed scarcity. Unlike the US dollar, which can be printed infinitely by central banks, there will only ever be exactly 21 million bitcoins. Ever, period, in an era of runaway inflation. reckless monetary printing, and government debts exceeding GDP. Bitcoin represents something no fiat currency can offer: absolute, verifiable scarcity. Reason 2. The macroeconomic context. We're living through a unique historical moment. Interest rates that remained artificially low for over a decade, governments printing trillions to combat crises, institutional trust at historic lows, desperate search for assets that preserve value. Bitcoin didn't emerge in a vacuum. It's a direct response to the perceived bankruptcy of the traditional monetary system. Reason 3. Irreversible institutional adoption. When the world's largest banks, pension funds, and even governments start allocating portions of their portfolios to Bitcoin, it creates a demand floor that simply didn't exist in previous bubbles. El Salvador made Bitcoin legal tender. Middle Eastern sovereign wealth funds are accumulating. This isn't retail speculation, it's geopolitical realignment. The bubble argument ignores the technology. Here's where the debate gets really interesting. The bubble argument often completely ignores the utility of the underlying technology. Blockchain isn't just Bitcoin, it's a revolution in one cross-border payments. Sending $10,000 from New York to Lagos, Nigeria, through the traditional banking system takes 5 to 7 business days, costs $50 to $200 in fees, requires multiple intermediaries, subject to arbitrary blocks. Through cryptocurrency takes 10 minutes, costs a few dollars. Direct, peer-to-peer, can't be censored by third parties. For the 2 billion people worldwide without access to traditional banking, this isn't speculation, it's economic survival. 2. Verifiable digital ownership. NFTs were ridiculed, and many projects were genuinely absurd. But the underlying technology solves a fundamental problem of the digital age: how to prove ownership of unique digital assets. This has applications in real estate title certificates, secure medical records, sovereign digital identity, combating luxury goods, counterfeiting. 3. Decentralization of financial services. DeFi allows you to lend and borrow without banks. Earn real interest on your savings, not the 0.01% banks offer. Trade assets 24/7 without intermediaries. Maintain total custody of your assets. This isn't theory. Billions of dollars flow through these protocols daily. The Internet of Finance. If the Internet was the information layer of the world democratizing knowledge and communication, crypto is the value layer. Just as you can send an email instantly to anyone on the planet, you can now send value. That's profound. Remember, in 1999, skeptics said the Internet was a fad, that people would never buy shoes online, that Amazon was overvalued. They were right about the bubble. Stocks fell 90%, but they were completely wrong about the technology. Those who survived the crash changed the world. Part 4. The inconvenient truth, 10 o'clock to 12:30. It's probably both. Here's the truth. Few have the courage to admit Bitcoin is probably a revolutionary technology wrapped in a speculative bubble. These two things aren't mutually exclusive. In fact, historically, truly transformative technologies always go through destructive speculative cycles. Lessons from history. The railway bubble, 1840s. Insane speculation led to thousands of railway companies, to 90% of them went bankrupt. But railways completely transformed civilization. The dot-com bubble, 2000. Pets.com web and hundreds of revenue-less companies swept away. $5 trillion in market value evaporated, but Amazon, Google, and eBay survived and dominated the 21st century. The pattern. 1. New technology emerges with real potential. 2. Rampant speculation inflates prices absurdly. 3. Brutal crash eliminates 80 to 90% of value for real technology survives and changes the world. The real question. The question isn't whether Bitcoin will crash. 50 to 80% correction cycles have already happened multiple times. The real question is, will Bitcoin survive the crash and come back stronger, just like Amazon did after the dot-com bubble burst? If the answer is yes, then buying after the crash could be the opportunity of your lifetime. If the answer is no, then even today's prices are overvalued. The crypto economy is here to stay. Here's what we know for certain. 1. The technology is real. Blockchain solves legitimate problems and is being integrated into sectors beyond finance. Healthcare, supply chain, governance, to adoption is accelerating. Each cycle brings more users, more infrastructure, more legitimacy. We're no longer in if territory, we're in how and when. 3. The speculation is equally real. Most crypto projects are garbage. Most traders lose money. Most alpha on social media is noise designed to make you exit liquidity. Investor or gambler, if you're chasing moons without understanding the underlying math, the technology fundamentals, or the macro risks, you're not an investor, you're a gambler. And there's nothing wrong with gambling, as long as you recognize you're gambling. The problem is when gamblers convince themselves they're investors. Principles for survival. 1. Educate yourself ruthlessly. Understand the difference between Bitcoin and Ethereum. Know what smart contracts are. Comprehend how blockchains work. If you can't explain it, you shouldn't invest in it. 2. Maintain healthy skepticism. When something seems too good to be true, it probably is. 1000% returns come with 100% loss risk. 3. Never invest more than you can afford to lose. This isn't a cliche, it's the difference between a financial setback and complete destruction of your life. If losing the money would mean not paying rent, don't invest. 4. Think in decades, not days. If you believe in the technology, think like a venture capitalist, not a day trader. The big returns come from holding through crashes, not trying to time the market. 5. Diversify ruthlessly. Crypto should be a small percentage of a diversified portfolio. 5 to 10% for the aggressive, less for the conservative. The future is uncertain and that's okay. Nobody knows if Bitcoin will be $1 million or $0 in 2030. Anyone who claims to know is either a liar or a fool. What we do know is that we're living through one of the greatest financial and technological revolutions in human history. There will be extraordinary winners and devastating losers. The crypto economy is here to stay, but its exact form, its winners, and its impact are still being written. Stay informed, stay skeptical, never stop learning. And remember, in the long run, knowledge and patience always beat greed and impulsivity. The future of money is being decided right now. The question is, will you be an educated participant or just another victim of your own greed? Choose wisely.